The war in the Middle East has been dominating global headlines now for a week, and naturally one of the biggest questions investors are asking is this: what does this actually mean for property in Dubai and the UAE? At first glance, geopolitical tension in the region might seem like something that should negatively affect real estate markets here. But when you step back and analyse how capital behaves during geopolitical uncertainty, the picture becomes far more nuanced. Before moving into real estate, I worked in private investment banking internationally, advising on capital allocations across multiple global markets. Prior to that, I served as a service member for the United Kingdom, so I tend to view situations like this through both a security lens and an economic one. And when you combine those perspectives, you start to see a pattern that repeats itself again and again. The first thing to understand is that real estate markets operate on long-term economic cycles, whereas geopolitical events tend to be short-term disruptions. We've seen this before in the region. In 2022, Abu Dhabi experienced a missile incident that made global headlines. Despite that, property transactions continued at significant levels, demonstrating something important about how resilient property markets can be when the underlying economic fundamentals remain strong. This pattern repeats globally as well. Whether it's a conflict in Eastern Europe, financial crises, or political instability, major global property markets rarely collapse because of geopolitical headlines alone. They move based on capital flows, economic growth, infrastructure development, and population demand. And this is where we can talk about capital behaviour. When geopolitical tensions increase, financial markets typically react first. Stock markets become volatile, particularly sectors tied to energy supply, shipping routes, and global trade. Investors holding those assets often begin reassessing risk exposure. At that point, capital typically begins rotating into assets considered to be more stable. Historically, those assets include government bonds, treasuries, and prime real estate in globally connected cities. Commodities like oil and gold are often seen as safe havens, but they can also be extremely volatile during periods of conflict. So institutional investors, family offices, and high net worth individuals frequently look for places where capital can sit more comfortably in the long term. This is where the UAE enters the conversation. Dubai in particular has spent 2 decades positioning itself as one of the world's most globally connected cities. It sits between East and West, operates within a business-friendly regulatory environment, and has built infrastructure specifically designed to attract international capital. Those fundamentals are why the Dubai real estate market has grown so significantly. In fact, the Emirate recorded around 917 billion dirhams in real estate transactions in 2025, with more than 215,000 property sales completed that year alone, reflecting the strong investor confidence and global demand. When you look at those figures in a global context, they highlight something important. Dubai is no longer just a regional market. It has become a global capital hub. And that's particularly relevant when you consider the geopolitical structure of the Middle East. To understand the long-term implications of the current conflict, we also have to discuss Iran and the structure of proxy conflicts around the region. For decades, tensions in the Middle East have often been expressed through proxy groups rather than direct state-to-state confrontation. This means that regional conflicts frequently involve smaller organizations or political movements operating in different countries, supported indirectly by larger powers. This proxy dynamic is one of the key reasons the region has experienced periodic instability over the past several decades. However, it's important to recognize something about the geopolitical systems. Periods of tension often precede structural change and eventual stabilization. If the broader geopolitical situation surrounding Iran evolves towards greater stability, whether through diplomatic resolution, internal economic pressure, or shifts in regional alliances, the implications for the Middle East could be extremely significant. When stability increases in a region that sits at the crossroads of global trade routes, several things tend to happen simultaneously. Trade expands, tourism increases, infrastructure investment accelerates, and the international capital becomes far more comfortable entering the region. The Middle East sits in one of the most geographically important corridors in the world, connecting Europe, Asia, and Africa. So when geopolitical stability improves, the entire region experienced rapid economic expansion. And this is where the UAE is uniquely positioned. Unlike many countries in the region, the UAE has spent decades building a diversified economy. Dubai in particular has focused heavily on finance, tourism, logistics, technology, and real estate, rather than just relying on purely oil revenue. This diversification has become extremely successful. Dubai's population has now surpassed 4 million residents, and the city continues to attract entrepreneurs, investors, and professionals across the world. Real estate is a key part of that growth. Dubai has become one of the most internationally owned property markets in the world. Approximately 30% of residential property value in Dubai is held by foreign investors, making it one of the most globalized property markets anywhere. That level of international ownership reflects a high degree of confidence in the city as a place to store capital. But it's also an important currency factor that many investors overlook. The UAE dirham is pegged to the US dollar. During periods of global uncertainty, the US dollar typically strengthens because it's seen as a safe haven currency. That means assets priced in dirhams can benefit from that stability. If the property prices remain steady while the US dollar strengthens, investors holding UAE real estate effectively gain value through currency exposure. In other words, the asset can appreciate passively through currency dynamics alone. But let's be realistic. In the short term, geopolitical tension can create hesitation amongst some international investors. Recent events have already shown that headlines can temporarily affect sentiment. Some buyers pause decision-making while they wait and see how the situation evolves. However, historically, this type of hesitation tends to be temporary. Dubai has experienced multiple global shocks over the past 2 decades: financial crises, pandemics, geopolitical tensions, and each time the market eventually returned to the growth once clarity returned. This happens because underlying fundamentals remain strong. Population growth continues, infrastructure expands, international businesses relocate, and capital continues flowing into the city. That's why the Dubai government has been able to launch long-term initiatives such as the Dubai Economic Agenda D33 and the Dubai Real Estate Strategy 2033, both designed to significantly expand the economy and increase property market activity over the next decade. These strategies are built around one core objective: positioning Dubai as one of the world's leading global cities. When people think about major global property markets today, they usually refer to cities like New York, London, or Singapore. Dubai is increasingly positioning itself within the same category. It offers global connectivity, high-quality infrastructure, a favourable tax environment, and a government that actively encourages investment and innovation. So when we return to the original question, what does the current Middle East conflict mean for Dubai property? The answer is not as simple as the headlines might suggest. In the short term, you may see some hesitation from investors who are unfamiliar with the region. But the majority of activity within the UAE property market tends to come from residents, entrepreneurs, and long-term investors who understand the structural strength of the economy. Capital continues moving internally. People upgrade properties, reposition portfolios, or acquire assets when opportunities appear. And historically, once geopolitical uncertainty begins to fade and stability returns, markets like Dubai often accelerate very quickly. In many cases, periods of uncertainty actually create opportunities for long-term investors. Because while short-term sentiment may fluctuate, the long-term economic trajectory of cities like Dubai continues moving forward. So the key takeaway is this: real estate markets are driven by long-term fundamentals, not short-term geopolitical noise. And when you look at Dubai through that lens, population growth, infrastructure investment, international capital inflows, and the strategic global positioning, the long-term outlook remains extremely strong. If you're currently watching this situation and trying to understand what it means for property in the UAE, the most important thing is to focus on those underlying fundamentals rather than reacting purely to the headlines. If you'd like to discuss the market in more detail or explore how these dynamics might affect your own investment decisions, feel free to reach out.